Sounds good. Let's move into our last segment here today, and that's going to be our focus on fundamentals here today, Greg. And are we calling it fundamental focus or focus on fundamentals, Matt?
Fundamental focus.
Fundamental focus. All right. Fundamental focus. What we've been doing here every Thursday for the better part of a month now. Coach Greg, we know him. We give him the nickname Old Money Holmes for a reason. The way that he looks at companies, the way that he looks at charts, the way that he digs into data and information. Fundamentals are a very important part of Greg's investment approach, the way he approaches the markets. And so we've invited him onto the halftime report each week to do some teaching and to help somebody, the community out there understand one concept in fundamental analysis better on a weekly basis. Greg, what do you got planned for us here today?
Well, I'm going to take the screen share here if you're good with that.
Yeah, of course.
And, let's see if I can get this to do it right. There we go, FinViz. So today we're going to talk about debt to equity. It's another ratio. We've talked about, price to equity. We've talked about price to sales. We've got a bunch of different metrics in the fundamental space here that are really, we're building a picture. We're painting a picture. The essence of fundamentals is you need a picture of what a company looks like from the inner working. So call it a blueprint, call it whatever, a map, whatever you want to call it. The reality is we have to put some things together. And so debt to equity, the one we're going to talk about today, the reason why debt to equity is so important is I want you to think about your own household or think about a nation or, any company for that matter. They're going to use debt for a couple of reasons, okay? They're going to use debt to run the business sometimes. They're going to use debt to improve the business sometimes. Most businesses have some form of debt, okay? Whether it's, again, building the business or whether it's just, running the business, there's lots of reasons to have it. The key to debt to equity, the ratio and why it's important is because it gives us an insight into the company's financial leverage. There are companies that are just rock stars with using debt to become better. And then there's companies that get into debt, that get themselves into real trouble. And I'm going to talk about all those things one by one here. But just to break it down, the debt to equity ratio, basically you take the total liabilities of a company and you divide it by shareholder equity, and it comes out to a ratio. Now, the ratio, if you think about that, if you have more liabilities than you have shareholder equity, that could be an issue, right? It's basically shareholder equity for those who are not familiar with it. Shareholder equity is just essentially assets minus your liabilities. That's what it equals, right? So it's a very simple thing. You can go to a balance sheet on yahoo.com. You can go to the balance sheet of any company. You can look at the assets, liabilities. You can minus that, and it gives you your shareholder equity. So these ratios are not hard to figure out, but they are important when you want to see how is the company managing their debt. Their debt can be, like I said, it can be really great, or it can really be problematic all at the same time. It's a double-edged sword. That's kind of the best way I can describe it. Leverage in general, for all you option traders out there, right? Leverage can be great. You can buy yourself a call option. You get a little bit of leverage out of that, and you can do well with putting in a little bit of capital. But in the same vein, you can also lose a lot because that leverage is there. So kind of think about that when you think about this ratio. So when we start to look at this, you can go in and again, the debt to equity ratio is just total liabilities over shareholder equity. It's very simple to figure out. However, we have it even simpler than that. If we look at FinViz here, they actually have the ratio right there for us. Okay, so debt to equity. So debt to equity for Coca-Cola here is 1.89. Well, what does that mean? Well, much like most other metrics, we need to compare that to other companies of a similar nature to understand how they're actually using their debt. Are they using it well? Are they using it poorly? And what does it really mean? So if we get out of this and go to a competitor of Coca-Cola, which Pepsi, we've been doing this for a couple of weeks now, and we go to Pepsi and we kind of look at this. So 1.89 versus 2.33, okay, for their 2.60, I apologize. So you've got a couple of different numbers there, right? Yet you've got very similar companies. So the question comes is, how are they managing their debt? Are these good? Are these bad? Well, again, the higher the ratio, potentially the higher risk to a shareholder. Okay, so just think about that. If a household has more debt, okay, the cost to service that debt can be problematic. Now, If that household is using that debt for a reason, like perhaps to create income or something like that, all of a sudden debt can become very good. Let me give you an example. Amazon is a company that uses debt very, very well. They've went in and let's just look at their number very quickly here, just so you guys can have a kind of just a view of this. But look at their debt to equity ratio. It's 0.59. It's very small, but yet they're a larger company. Now, we can't compare their number exactly to Coca-Cola because the companies are different. But the point being with Amazon is they use their debt very well in the fact that they go out and buy other companies. They buy, Whole Foods and other things like this. They build their business with their debt. That's a good thing. However, if the cost to service the debt is too high, that becomes a bad thing. So when you start to use this metric as a form of comparison, like we did with Pepsi and Coca-Cola, then you can say, okay, the higher the debt, chances are, the higher the debt, the potential higher cost to service that debt. And so it can become problematic. Okay, if it's not a problem and it's used to build more revenue, then that can be a good thing. So you can kind of look at these two different things and kind of look into them. Now, the one thing I want to say is there's a difference between short-term debt and long-term debt. Okay, so when we start to break this down, there's another ratio that's akin to this debt to equity, and it's called the current ratio. What it does is it takes the debt to equity ratio, instead of being total liabilities, what it does is it looks at short-term debt versus long-term debt. Okay, long-term debt can be problematic because it can weigh down the cost of servicing that debt, can weigh down on a company's equity or a company's earnings. So long-term debt can be problematic. So if we go and we look at the current ratio, this gives us a bird's eye view of what, let me get back to Coke and Pepsi here just for our comparison's sake. This can give us an idea of how they're managing their short-term debt versus their long-term debt. So this current ratio, their debt to equity is 1.89. Their current ratio is 1.50. So what that means is their debt, or their long-term debt, is actually quite small when you start to take these numbers. And you can do this individually, but FinViz gives us these numbers very easy, so we can make this a quick process. So basically, if we look at this, 0.39 would be the long-term debt portion of Coca-Cola. So you can quickly look at this and go, okay, it looks like their current ratio is actually pretty good. So they're managing their short-term debt. Now, if we go to look at Pepsi, and again, these are all comparisons that we use. If we go to look at this, we can say, okay, they had a higher debt ratio, but look at their current ratio. Their current ratio is quite a bit smaller, which means a lot of their debt is longer term. So if we take this in a vacuum and we look at this, we could say, okay, it appears that Pepsi has more long-term debt than Coca-Cola. And this can be one factor of many when we look at fundamentals. Ideally, I think anybody could agree that if a business had no debt and yet they were still making revenue versus a company that has debt and is making the same amount of revenue, we would say that one is better than the other. So really the debt to equity ratio is that comparison of, okay, how are they managing the leverage of their debt? And if it gets too big, it can be problematic. If it's in line and it's used for specific reasons to generate revenue, then it can be a good thing. But just comparing the two from a debt to equity ratio can give you another piece of the puzzle when it comes to a fundamental look into a company. So that's your debt to equity ratio. Like I said, there's, I kind of went over the formula there, but we're lucky that we have places like FinViz here, gives it to us very quickly. And again, we can start to build on these building blocks, right? PE ratios, price to sales, price to book, net tangible assets, all these things that we've been talking about each week. We're now adding another block on this to give us a really good fundamental picture.
Very interesting, Greg. And let me ask you one clarifying question just from the conversation. So when you're using debt to equity ratios and analysis, how important is it that you're looking within industry comparisons? Like you did Coke versus Pepsi. I mean, would that also apply to other food companies? Do you like to keep it like specifically when you're looking at a beverage company, look at another beverage company? Like how do you use that when you're comparing like the way you did here today?
Yeah, so it has to be similar businesses, right? So everything we've talked about in fundamental analysis, I can't compare Berkshire Hathaway and Coca-Cola. I can't. They just, they're two totally separate businesses. One may be very debt laden and it may not be a problem. The other may be, very little debt and it might be a problem, right? So you actually, anything in fundamental, I've yet to find any metrics where you can't compare apples to apples, right? So I picked Coke and Pepsi, and again, I could do this with oil companies like Exxon and Chevron. I could do this with anything that are similar companies, because I want to understand, how that ratio affects their business. Okay.
Sure.
And so for this one, Pepsi and Coke, yeah, they have different price levels, but they do the same business. So if one has lots of long-term debt and another one doesn't, and yet they do the same thing and they make similar revenues, then, like I said, it just kind of builds that picture up to say, okay, maybe they don't manage their debt quite as well as the other one that's in a similar business. Okay. Now again, you can't do this standalone. Like I would never just buy one company on a debt to equity ratio, but it's definitely something I'm going to consider, because when I look at valuating a company, any company, I need to know, okay, are they carrying too much debt? Is that going to affect them in a business downturn? And a lot of the numbers that we talk about here and we have for the last few weeks here, it's only if the business has a problem where these become glaringly obvious. And this is probably, so far of the ones we've talked about, this is the most glaring when things get bad. If revenues start to fall and they're carrying this debt, a lot of that revenue, a lot of that earnings and equity, that's going to have to pay for that long-term debt. And it's not like they can just go, okay, well, we're just not going to do that. So it's these, when we look at fundamentals, I'm looking at something because I expect to hold it, longer than a swing trade, longer than a position trade. This is more of an investment. So I want to know, how will they fare during an economic downturn or a business downturn, and that debt to equity ratio is a very important one for that reason.